Did you know there's a way to retire early with just dividends and pay $0 in taxes? And building a dividend portfolio is by far, in my opinion, the easiest way to create passive income. And having a taxable brokerage account can be extremely powerful, especially when you have a 401k, TSP, or IRA that you can't touch until you reach your normal retirement age of 59 and a half. You're probably wondering what types of stocks, ETFs, or mutual funds you need to invest to get dividend payments. Most of them pay you on a quarterly basis, which isn't always ideal when you have expenses every single month. But there's also a way to strategically invest to get paid dividends every single month. So how awesome would it be to retire early in your 30s, 40s, or 50s and live on dividends while paying $0 in taxes, right? My wife and I are working to achieve $3.7 million in Fat Fire to retire early by age 45, and dividend investing is a big part of our Fat Fire strategy. If you're brand new to my channel, my name is Sai and welcome. So in this video, I'm going to talk about the dividend stocks we're currently investing in our taxable brokerage account, how to choose dividend stocks based on their dividend payment months, dividend payout ratio, and the length of dividend increases like dividend aristocrats or dividend kings, and how to pay $0 in taxes when you live on dividend income during your early retirement. This is another juicy video, so make sure you grab a pen and paper and take some notes. Now, I don't know about you guys, but I'm excited to retire early on the beach without working a 9-to-5 job. Work sucks, am I right? First, let's talk about qualified dividends. And we only invest in stocks that pay qualified dividends. And in order for you to get them, you have to hold a common stock for at least 61 days out of the 121-day period that began 60 days before the ex-dividend date. And if you have a preferred stock, which is what employees get when they work for public companies, and they have no voting rights like the common stocks, then they will have to hold them for at least 91 days out of the 181-day period that began 90 days before the ex-dividend date to get qualified dividends. So when you research a stock, you can always look for the ex-dividend date, and that means it's the cutoff date for investors to hold the stock in order for them to get the dividend payment. And this rule is set by the SEC. The ex-dividend date is usually the day before the record date, and the record date is set by the company's board of directors when they compiled a list of investors who invested in the company prior to the ex-dividend date and determine if they will receive dividends or not. And the payable date is when investors get their dividend payments. Simple, right? Let me give you an example. I purchased say 100 shares of Verizon in the year 2022 for $50 per share on March 1st. If I sold 20 of these shares on April 15th, but continued to hold the remaining 80 shares and the ex-dividend date was on April 1st, because I held my 20 shares for less than 61 days, the dividend income for those 20 shares would not be qualified dividend income, and they would be taxed as ordinary dividend income. The other 80 shares are qualified dividends because I held them for at least 61 days in the 121-day window. So with a 5% annual dividend yield, $12.50 in dividends out of that 20 shares would be taxed as ordinary income tax. And the other $50 in dividends out of that 80 shares will be taxed as long-term capital gains tax at 0, 15, or 20%. You also have to keep in mind that some stocks only pay ordinary or non-qualified dividends. If you receive, let's say, employee stock options or ESOs, or invest in real estate investment trusts or REITs, then these earnings are taxed as ordinary dividends or federal income tax. If you're still confused about how qualified dividends work, you can schedule a free 20-minute financial coaching session by visiting firesidechat.com/coaching. Now let me talk about the dividend stocks we own in our taxable brokerage account, and by no means this is any financial advice. I expect you to do your own research before you invest in any of my stocks or other securities. Our strategy is to invest in multiple dividend stocks that have the potential to appreciate over time. The companies need to have growth potential, or the stocks have to be undervalued at the time we buy them. So when the stock becomes overvalued in price, then we just hold it for the long term. Our goal right now is to reach a $250,000 total in the dividend stock portfolio. Initially, we have $50,000 with 5 stocks, $10,000 with $25,000 each. When we eventually get to $500,000, we'll have anywhere between 15 and 20 stocks. And then when we reach $1 million, we want to have $50,000 in each stock. And we're currently investing $50,000 a year into our dividend stock portfolio. By the time we turn 45, we should have well over $1 million, making at least 4% in annual dividend yield. Since these are all qualified dividends, we will be taxed at 0% in capital gains taxes, making $40,000 a year in dividend income. You can get these spreadsheets for free by visiting firesidechat.com/contact, and just by signing up for my email list, you'll get free financial tips once a week. So by the time we have $1 million in our portfolio, we would like to have at least 15 stocks with $50,000 each. Since we're married and filing our taxes jointly, we could pay 0% in capital gains taxes if we keep our taxable income below $83,000 after the standard deduction. You should also check out the video I did on how we plan to pay 0% in capital gains taxes, and I will put the link in the description below. The first stock we own is the JP Morgan Chase, ticker symbol JPM. This stock is paying a 3.5% annual dividend yield. The ex-dividend dates are in January, April, July, and October. So with $10,000 invested in this stock, we would get paid $350 annually, or about $87.50 in January, April, July, and October. The second stock we own is the Walgreens Boots Alliance, ticker symbol WBA. This stock is almost paying about 5% annual dividend yield. The ex-dividend dates are in February, May, August, and November. So with $10,000 invested in this stock, we would get paid $500 annually, or about $125 in February, May, August, and November. The third stock we own is Raytheon Technologies, ticker symbol RTX. This stock is paying about a 2.3% annual dividend yield. The ex-dividend dates are also in February, May, August, and November. So with $10,000 invested in the stock, we would get paid $230 annually, or about $57.50 quarterly. The fourth stock we own is Verizon, and ticker symbol VZ. This stock is paying about a 5% annual dividend yield. The ex-dividend dates are in January, April, July, and October. So with $10,000 invested in this stock, we would get paid about $500 annually, or about $125 in January, April, July, and October. The fifth stock we own is Pfizer, and ticker symbol PFE. This stock is paying about a 3% annual dividend yield, and the ex-dividend dates are also in January, April, August, and November. So with $10,000 invested in this stock, we would get paid $300 annually, or about $75 quarterly. So to sum it all up, in January, April, July, and October, we would make $287.50 in those months. In February, May, August, and November, we would make $182.50 in those months. The only months we're missing are March, June, September, and December. We're not prioritizing or necessarily prioritizing our investments based on the dividend income months. This is something we'll worry about when we're near our retirement. But if we were to retire now and we want to receive a dividend payment every single month, here are some other stocks that we would consider purchasing in the future. And American Electric Power, or ticker symbol AEP, pays dividends in March, June, September, and December. Other stocks that pay dividends in those months are Johnson & Johnson, McDonald's, Target, and UPS. I mention these stocks because they're all either dividend aristocrats or dividend kings. A dividend aristocrat is a company in the S&P 500 index that has been paying and increasing dividends for the past 25 straight years. A dividend king is a company that has been paying and increasing dividends for the past 50 straight years. And these companies have survived some of the worst economic recessions, geopolitical tensions, and other uncertainty in the market. One thing to keep in mind is that there are always risks associated with buying individual stocks, and even for dividend aristocrats and dividend kings. AT&T, for example, is no longer a dividend aristocrat after they cut their dividends in 2021 to rebalance its businesses and balance sheet. And a lot of dividend investors cared about the fall of AT&T, especially during a bear market, because this is when we see that companies make it or break it. And the S&P 500 index is down over 20% year to date, and a lot of the companies are down by double digits as well. As share prices continue to drop, their dividend yields increase. And when investors have to pay attention, what they have to pay attention to is their quarterly financial reports. Are these companies still paying and increasing dividends annually? And I personally like to look for stocks that have long-term growth in revenues and earnings around 10 to 15%. I pay attention to the dividend payout ratio on their balance sheet because that's one of the indicators for their short and long-term outlook. When a company's dividend payout ratio is 50%, it means that they're paying 50% of its profit in dividends to its shareholders as a way to say,
thanks for investing in our company.
A healthy public company would reinvest the other half of its profits for research and development, real estate expansions, or the development of better products for its consumers. I've seen companies that pay over 90% or even 100% of their profits to their shareholders, and that's not healthy because they're not reinvesting into their businesses, right? And there are companies that take out debt just to pay and increase their dividends, so investors don't sell their shares. So the bottom line is it can be tough to pick dividend stocks, and you have to pay attention to the company's business models, cash to debt ratios, EPS growth, and strong cash flows. And you have to be mindful of how the industry behaves over time, especially during an economic recession. And Target, for example, just lost over 38% in value due to a decrease in demand and an increase in supplies. McDonald's has lost about 7% since the geopolitical tensions in Europe, but Johnson & Johnson is up about 4% year to date. You have to keep an eye on the sector trends and keep track of how consumers spend their money in restaurants, healthcare, technologies, and travel. Our goal is to make at least $3,300 a month from our dividend stock portfolio, and that's a total of $40,000 a year. If my wife and I are just going to live on dividends, then we could live up to $83,350 in dividends and pay $0 in taxes. This is not counting our standard tax deduction, and please keep in mind that I'm not a tax professional. What I would like to do, ideally, is to keep the taxes at a bare minimum as much as possible. And we're gonna get what's called Form 1099 Div from our broker, and in this case will be Charles Schwab every February. Anytime you get $10 or more in dividends, you're gonna get the Form 1099 DIV or DIV. So let's say we only want to live on our dividends during our early retirement. We're gonna need about $2 million in a dividend portfolio, yielding about 4% every year. And that's $80,000 a year in dividends, right? So what's nice about this is we pay $0 in taxes if our qualified dividend income is under $83,350 in the tax year. And this is all based on the 2022 numbers. These numbers will continue to increase, and the IRS will release the new numbers around October or November every year. The IRS will tax our ordinary income first at the highest rates, and then long-term capital gains and dividends are taxed second at their lowest rates. Let me give you an example. Let's say we're going to make $200,000 in gross income during our Fat Fire retirement, and I'm gonna again use the 2022 numbers with the standard deduction of $25,900 since my wife and I will file our taxes jointly. And let's also say our dividend income is $80,000 out of our taxable income of $174,100. We will be taxed about 13% or $12,000 in federal income tax, and the higher tax bracket is around 22%. Our dividend income will be taxed at 15% because we're above the income threshold, right? So our total taxes owed will be around $24,000. However, if we decide to just live on $200,000 in qualified dividends and capital gains from selling index funds, then the first $80,000 will be taxed at 0%, and the remaining $94,100 after the standard deduction will be taxed at 15%, which is about $14,000. I will save about $10,000 in taxes from the previous example, but I would rather have some earned income, something like from our business, to be able to contribute to our SEP IRA, simple IRA, or traditional solo 401k at $61,000. to reduce our taxable income. So like I said before, make sure you have a solid tax saving strategy before you retire early. Every one of you has a unique financial situation, so this is not any specific financial or tax advice. And if you want to know more about how to invest in dividend stocks or creating a dividend stock portfolio, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.